Manager of a fund that does private debt in real estate in bridge loans, and we'll cover that towards the end. But let's dive in. One of the things that you can read this agenda on your own. I'm not going to read for you. But one of the things I want you guys to put in your mind is in my years of doing this, and I think most people, if you've been around for a while, you sat down in an investment meeting and you spent about 4% of the time talking about the weather and your family. You spend about 95% of the time talking about the equity side of your portfolio. And if there was time enough, that last couple percent or half a percent, you glanced over the fixed income because historically there just wasn't that much to talk about. Most people just used it as a dampener to the portfolio or an emergency fund of that sort. But most people were equity and they've been equity for a very, very long time. And we're going to talk a little bit about that, but keep that in your mind about fixed income is no longer going to be that boring section, and it hasn't been for a while. And there's just so many opportunities for investors now to look at the fixed income piece of their portfolio through the growth of private debt and through the variety of different instruments and really make this a powerful engine within your investment scheme and really help you meet maybe even greater expected returns in your portfolio. Hopefully in that little ranter, you guys had a chance to walk through our agenda. Let's get started. Private debt. I always hear this like, oh, private debt's new. Private debt is not new. Private debt has been around long before us and long before many other things. It goes back to the medieval ages. You had bills of exchange. Can you imagine trying to cart pounds and pounds of gold? Eventually people realized, let's not actually move the physical coins. Let's have a piece of paper. The Greeks were found to be doing this very early in their trade in the Mediterranean. Other than if a little trivia there is they also used to trade olive oil as a form of currency too. So private debt and the structures of bill of exchange has been around forever. The Medicis were found taking on debt to build cathedrals and fund art. It is not something new. It has taken on so many different forms. It's been under scrutiny and then a series of laws. England is, you can see there back in the 1500s, act against usury because people were charging too much to, lend money. So now, governments had to step in and regulate. I think it's funny that it's still going on to this very day that government constantly has to come in and regulate people. It's one thing you can estimate. If there's something new being created, you probably want to wait until there's some kind of regulation on it, or it's wild, wild west. And then obviously the massive adrenaline shot in the private debt space, the great financial crisis, which I just call 2008 because I was fortunate enough to live on the front line of that and deal with some of those problems. But that was the massive growth of where regulations came down, banks were restricted, and you saw the explosion of private debt. There's one other thing that's not listed here. We had another adrenaline shot in 2022 when everyone realized, oh my God, in certain instances and certain scenarios, you can have equity and fixed income go down at the same time in a catastrophic fashion. And I'm pretty sure if you guys had your traditional fixed income in 22, you're probably still crawling out of that hole. It's going to take a while when you're down anywhere from 10 to 14% on traditional fixed income. It's going to take a while. And there's some areas of where people realized, hey, wait, a lot of private debt sectors didn't suffer as much as traditional fixed income. So that kind of goes into that theme of maybe there's a way to create a new fixed income portion of your portfolio and diversify even amongst fixed income. And we'll talk about some of that. Here again, I talked about some of this is you had 2008. You had, liquidity and risk and oversight problems. There was all types of leverage issues. I'm not going to go through. If we want to do a separate seminar on the exact events of 2008 and all the problems, we can talk about that. Now what you're seeing is major banks, they're stepping in and creating entire divisions of not just, hey, let's make the traditional loans. Can we actually participate and start to play in this private debt space? And we have seen that in spades, for better or worse. We're seeing some of it actually turn around and hurt people, especially the fund managers. I don't think they realized the source of capital and how retail investors or smaller investors think on comparison to large endowments, pensions, and institutional. But you saw this explosion of institutions coming in, the BlackRocks, the Goldmans, Blue Owls, everybody. There's just, no lack of major players, very smart people creating amazing products. And they realized they couldn't fund it. So they went into the retail side. And now they're finding that, hey, when you tell somebody you're going to do something and then you don't actually perform, some of your smaller investors can be far more emotional, be more fickle, and now you're seeing some redemptions out of those bigger projects. I want to talk a little bit about the capital stack. It's important to understand that, most people who've traditionally invested in equity, congratulations, you've had a great run. I mean, the S&P 500 and most equity indices have been absolute juggernauts. Not going to complain about that at all. But as you may look to shift or look towards more fixed income, or you're looking at saying, hey, how else can I think about my fixed income portfolio? You can start looking at other areas that, you get preferred equity, you get mezzanine debt. Most people think, oh, it's a senior debt situation if I'm going to have in fixed income. And that's, if you're looking for risk controls and dampening of volatility, well, yeah, you're probably going to be in that, senior debt tranche. Why are you there? Well, let's just be honest. When something goes wrong, the collateral support goes from the bottom there. The senior debt is, the safest spot. It's the first at the feeding trough. Next, you might have some type of clause into remaining capital at a mezzanine or a second lien type position. And then up the curve, obviously, equity is paid less and less of that amount, if anything is left. And sometimes you'll look at a number of projects. I know a lot of people in, syndications in real estate have been on that common equity side. And by the time properties get sold and people get paid back and accounts payable is covered, there's very little, if anything, left on the common equity side. And so for some of you, you might know this stack all too well and not terribly happy about it, but that's just a quick overview of obviously the sort of the risk and return profile. Obviously, common equity, you're going to get paid more, if it works out. But if it doesn't work out, you might be in trouble. And that's where a mix of this and looking at specific private debt can give you equity-like return without taking that equity level risk. So that's something there. Also keep that in mind. So you can see here on the left, you've got a chart that's showing the growth. And private debt comes in lots of forms. There are public instruments, business development companies. Many of you might be familiar with those. It's really, I kind of call it the corporate lending instrument, where most people think of REITs. BDCs are organizations coming together to lend to corporations. So their basket of loans and private debt is lending to businesses, often not, sometimes in your, mid-tier and lower tier companies. And then you can see that the growth of BDCs, because they are regulated, because they are public, you've seen a massive growth in that. And people think that that's going to continue to move forward. Now, I laugh because this chart was put together before the most recent news. So I wonder, a lot of BDCs are under fire right now because of AIs and their effect on software companies, because a lot of these BDCs, sometimes 30 to 40% of their portfolio were software companies. And now if you're going to see some problems in those companies, you're probably looking at a situation where those BDCs are going to have some pretty big write-offs. People might be pulling out, may not look to invest, and you might not see the growth in that area that this chart might forecast. So a little bit of recent news that might overlap that chart. But regardless, what I want to show there is it is growing. It's growing across multiple different tiers. And then you can see the chart or the graph on the right. This is where it can get daunting. I understand. I mean, it is so many things to think about of, hey, am I doing direct lending? Am I going into distressed? Am I thinking about distressed lending? Then there's, credit special situations. I kind of find that a lot of private debt is in some form of credit special situation. Mezzanine debt, bridge financing. That's what we do. But bridge financing comes in so many different forms, even within that subcategory. And then specifically real estate debt, you can see it's been pretty even through this entire chart on, its percentage of the market space. This gives you the idea of the complexity of what, people talk about private debt, and I just really feel like they're talking about one thing, and it is not one thing. It is very complex, and you will find to take this to a next level of complexity in your fixed income bucket alone, if you have the capital base, let's say you work for, medium sized or large family office, you could have an entire division that's just focused on what your allocation is and the cross correlations of building a portfolio just in private debt alone. I mean, it is, and I know people who do it. So it is very complex. You have to find what really fits for you and your risk profile and what you can understand. I mean, if you don't understand something and you're investing, that's like you can go back to one of my due diligence webinars. I mean, you probably shouldn't. I mean, because if you don't understand how the investment works, you certainly don't understand how it's going to break. And that's a really important piece. You got to understand what breaks it. What breaks this? And, and having been in traded things and seen, I thought we had trades that couldn't be broken. And you know what? The absurd always ends up eventually happening and breaking it. There's nothing that's 100% foolproof. We take risk to make return. That risk is a reality. Anyone who tells you otherwise is full of it and you should walk away. But yeah, moving on. I just wanted to kind of give you sort of a lay of the land of private debt. Also, the CAI and a number of other people have done research papers of like, hey, maybe private, when you're looking at your fixed income portfolio, it's not all, hey, am I all alternatives? Am I all private or am I all public? They found a number of different scenarios of where having a bit of both can be very, very helpful. Obviously, one of the key things is, if you're in private fixed income, I mean, we want fixed income to be a little bit more liquid than our equity plays. Be reality. It's private debt. There's going to be an illiquid faction to it, and you need to be aware of that. So if liquidity is an issue, you can look at your fixed income portfolio and say, well, wait, maybe I do still have some mutual funds or ETFs that invest in intermediate government bond funds. Great. I understand that they're not going to produce 8, 9, 10%. But I know also that if there's an emergency moment, I will have that immediate liquidity and that capability to do that because, even in our fund, we have quarterly redemptions. Now, if we've got loans rolling off and there's enough capital, great. We'll get you your money back as fast as possible, usually in the next month, but it's not immediate. There's always a liquidity faction to this. And so you really have to understand that asset and liability match. And I do not want to go down that road too much here because that's now getting back into due diligence aspect. But here's some differences between private debt and public debt. Obviously, the biggest one, the second one there, illiquid, versus highly liquid. One of the key factors of private debt and why it will continue to grow and be a powerful force in fixed income is the customization capabilities. There are so many loans, even in our tiny little niche, that need some level of handholding, understanding, and customization. Not every loan demand is a square peg that's going to fit perfectly in that square hole. That's what the big banks are for. Those guys are there to absorb those big loans that are very standardized and make that happen. That's not how our world works. We know it's not how it works in multiple different fronts, and this is no different. And that is one of the key angles of when you're looking at private debt, and if you're looking to make an investment into a fund, is what is that uniqueness? What is that inefficiency that's being taken advantage of that needs that customization? Why does it even exist? And is it going to be repeatable? And is it ongoing? There's a lot of great trades. Being an ex-hedge fund trader, there were trades you'd get into that worked great, and all of a sudden within a year they were gone. Something changed. It changed regulations, whatever happened. And I'm not seeing that in private debt. Private debt it's going to be needed, and it's going to be needed on so many different fronts, mainly due to that, third item there is sort of that customization. Access. Well, I think, when I put this slide together, limited to institutional and credit investors, that's still a limiting factor for the majority. But I think also that is getting better and has gotten better. As I said earlier, we now have access, even as accredited investors, and we'll see if the test for being an accredited investor is going to get done this year or not. But that might open that level to where the people who don't make 200,000 a year or 300,000 as a family, or have $1 million in net investable assets. There's a lot of smart people who I've talked to, and they get this space, but they don't meet the current rules. And I think that they could easily pass the test and come in and be a part of this world. Understanding private and public, because I'm not saying you should be all private debt. I'm not saying you should be all public. That is an individual choice. I'm not your financial advisor. I can't tell you what to do. I just want to open your eyes to, wow, we are living in a time where, yes, it may be daunting, it may be confusing, but there are so many things we can do on the private debt side that can really enhance your fixed income part of your portfolio, which normally, as I stated earlier, has been the most boring aspect that we can possibly believe in investing. I bet most of you have fixed income and you probably don't even know what it is. You just did it because that's the allocation that you were supposed to be given. Here, I want to dive into this next piece. These are real numbers. This is all internal. If someone wants to see these numbers, I've got spreadsheets upon spreadsheets that we can walk through, but these are real indice numbers. They are, we'll get into some numbers that we have for the Kirkland Income Fund, as obviously I want to throw in and see how we impact all this. But really, really interesting. You saw, you've got, the past 10 years, you can see private debt, you know, generally was less muted. It moved around. There's some correlation to general events, but the MSTR Levered Loan Index, which if you don't know what that is, real quickly, it is a index that tracks relatively larger loans, 100 million and over, that are lent to companies that already have some form of leverage. So it's a corporate indice. It's not a real estate industry. I would love if someone would come up with a indice that I could regularly pull down and it was commensurate to more real estate. You got to pay for those, unfortunately. People like to hold on to that. But this gives you the idea that I want to present. This is like, hey, look, private debt does mute, even, within the world of fixed income. So that's the AG. If people don't know what that is, that's the Bloomberg Aggregate Bond Index. It's 20,000 corporate bonds, all public. JNK is the ETF for junk bonds. And then you got the Dow Jones, corporate bonds. So that's investment grade corporate bond index, mostly dealing with, laddered treasuries and structures like that. Obviously, you can see in 2022, pretty ugly year for public debt. We all know kind of what happened there. But you can see there again, okay, it's not that private debt was immune, but it reacted a lot less. And a lot of that, you have to understand, is the ability to sell and the effect of emotion. So when people panic, they realize something's going on. It's not something they want to hold. And then there's this rush for the door, and everyone, because you can sell it, you do sell it. And so some of that muted effect is there was nothing really impaired perhaps in those portfolios in a major way, but you have a large price movement because people just want to get out of the way because they don't understand how bad that's going to be. You can see, obviously, the impairment was not as bad as most people thought, and you had a good retracement of value in the underlying assets of all of these. The other one, the volatility aspect, is you can see private debt took a real specific hit in 2008. There again, muted volatility. And if you're wondering, 2001, 2008, 2015, 18, 20, and 22, those are all very specific events that affected fixed income. So those are years where you had a particular event that was negative for fixed income. And you may ask, well, wait a second. What if we have it under 2008? Well, for people who lived through that's not really possible in today's world to have the exact same play out. But 2008, at the highest level, it was a liquidity event. That's what caused it. And so when you didn't have the liquidity and you just didn't have buyers, all you had was sellers. And I got to see this on the hedge fund side, point blank from a number of different, credit spread traders. They were going out and buying fully functional, pieces of debt on companies that weren't actually struggling, and they were able to pick it up on 20 cents on the dollar because it just, people had to sell. There were just, have to sell. There's limited buyers, and for the buyers that were there, I know I was talking to one purchaser. He goes, "Yeah, I bought a piece of debt for 60 cents on the dollar, and the very next day it was trading at 40." And he didn't buy it at 40, and he turned it up expanding his tranche, and he bought more at 32, 30, 29. And he kept on adding to a great position. And you can see some of those credit trading hedge funds just killed it in 09 and 10 and 11 because everything came rushing back when they realized, oh, The world's not going to end, and liquidity is going to be here. And yes, we had to come and have a major government, you know, savior of the financial system, but you can see private debt. You know, everything has a weakness. Everything, you know, there's nothing that's immune to everything. And so it's something to think about when you're looking at private debt. If you're going into some kind of massive liquidity crisis, and that could be an impact, especially to your, you know, your bigger loans, especially into corporations, is where you saw most of this damage. It's something to be aware of. It's something to say, hey, great, I don't want to load the boat, or I want to, be paying attention. It's not a fire and forget. Got to understand what you own and where it breaks. And so I just wanted to share that private debt is not this panacea. It is not this savior of all time. It does have its black eyes every once in a while. But for most occurrences, 215 down a little bit. Wow, 18 up. We saw earlier in this volatility on the past 10 years in 22. I mean, on a relative basis, volatility was very low. All right, I really love this page, and now we're going to move on from it because I could talk way too long on so many different factors that are going on into each one of those events. Um, Private debt, key benefits, things to think about. Portfolio diversification. And I'm not talking about diversification across equity and fixed income. I'm talking about potential diversification even within fixed income. So you can find instruments that really have low and sometimes even negative correlations across multiple assets. Even you will find there is correlation, low correlations, even sometimes between, private debt to companies and private debt in real estate. And then there's private debt in trade financing and shipping. I mean, there's just so many amazing little trades and niches that are inefficient, and you will find that trade in one way or another doesn't move lockstep or have the same volatility as other private debt. Low correlation with traditional assets. Most people have traditional assets. I have a traditional asset portfolio. I love my own fund because, well, the market's going to have a hiccup and my equity portfolio goes down, and my private debt and bridge loans to commercial real estate doesn't care. That's the things and the scenarios you're looking for and that you want to build and understand. Um, Private debt can actually generate functional income. Most of the reason why people never cared about looking at their fixed income portfolio historically is because it never really made enough income for anyone to really care about. 3%, 4%, 5% at the most. And so unless you're in the Reagan years where it was making 12, 13, 14, it wasn't exciting. But now you're looking at private debt can create 7, 8, 9, 10. You want to go all the way to the venture debt scale. I know guys that can do 18 to 20. Now you're taking risks to get that, but it can be a debt instrument and still produce outsized returns, and relatively stable returns. I mean, that's the whole idea of fixed income. You will have movement. I mean, 2024 and 25 was a perfect example of where, unless you're in a private debt fund that has a locked payment, like I will pay you 9% no matter what. If you're in like my fund, we run a basket of a debt and we pass those returns onto those investors. And so what we saw in general was, hey, it was really not an effect of lowering interest rates. Lowering interest rates on a public basis affects private debt a lot less than people realize. But when you just have uncertainty in the markets, there are global macro factors that just, hey, you're going to have greater stress on certain borrowers. You're going to have, hey, people don't want to do loans right now. We saw that at the beginning of 2025 with the change of the administration. You were looking at a scenario where, man, a lot of your strong borrowers that wanted to go out, they just didn't want to do any work. They're like, I'm not really sure what's going to happen. We might be, remember all the fears, hey, we're going into stagflation. In early 2025, people just didn't want to do any business. And so if people don't want to do any business, you can't make a loan. And all you're left with is the people you don't want to lend to, which that's what we saw. We saw a lot of loan demand. People always want money. You just don't necessarily want to write them a loan. So you saw across not only our fund, but multiple private debt funds that I know had an increase in cash positions in 2025. They were just like, well, I'm not lending these people. That's dumb. So I'm going to hold a little extra cash. Inflation protection. This is a little particular. You have to do a little bit of research on the debt fund that you're looking at to really understand, okay, How are they protecting against inflation? Are they a variable, floating interest rate? Are they short term? Like us, we do, 12 to 18 month bridge loans with most of everything we do is 12 months. So you're looking at a situation where, you know, inflation, I can adjust. I can adjust my rates. I can move to say, okay, great, inflation's up. They're going to raise rates to battle inflation. Well, okay, I can capture those higher rates, and then battle inflation. I mean, I have those movements and those capabilities in a shorter window. If you're going into something that's 5 year, 10 year paper, well, okay, unless it's a floating rate, if it's a fixed rate, then you're going to be locked into whatever that's being paid. And if that fits for your portfolio, that might be okay. I'm not saying that's the end of the world. I'm just saying, okay, hey, the world's saying I'll pay 8 and you're only getting 7. Okay. I mean, that's not the end of the world. Yeah, you're being paid less than what the market's paying currently, but it depends on your individual portfolio. Is 7% good enough for your expected return and the risk that you want to take? Maybe. So, I mean, don't be so worried about, where everything's going and it slightly turned against me. If it still works for you, it's not broken. That's one thing that as a portfolio manager, I really had to get that and build that mentality into a lot of people. It's like, if you can make adjustments, great, and capture as the market's moving. If you can't and it still meets your plan, then you're okay. And attractive yield opportunities. Risks. There's always risks. If you're getting paid money, you're taking risks. So you got the illiquidity factor. Now, I'm broken on this. I've been around for a long time, and I have been in areas, and I showed you some of the, hey, look at the volatility of what the MSTR levered loan index did, and some of that muted volatility was due to you can't be part of panic selling. So there is an aspect of illiquidity if it matches your investment profile, and you can absorb that. Whereas, like, let's just be honest, IRAs, that's a longer term investment. That's going to be around longer. Your short-term taxable cash you might need for something in a shorter time period. Hey, I'm looking to buy a house, or I got to pay for college. It's like the IRA is something that's like, depending on your age. Now, if you're in your 70s and you're taking your RMDs, well, yeah, okay, liquidity is a little bit more important. And I tell people all the time, balance your fixed income portfolio out if you're older, to where you might have some private and some public, to where you have that liquidity you might need in your later years. But if you're younger, middle aged, an IRA by definition is around longer. So maybe that illiquidity is not really a risk to your portfolio. So think about it a little differently rather than, oh, can I just sell tomorrow? No one's going to pay you 10% and you can get out tomorrow. If you find that investment, tell me about it, and I'll probably find a hole and a problem with it. You're taking, obviously, credit risk. Well, credit risk is something that's not shared just with private debt. That's public. That's just part of fixed income investing. You have to understand, okay, well, what am I lending to? And that supported collateral, is it stable collateral? What credit risk am I taking? Because you could have defaults, you could have bankruptcies of corporations. One of the big problems with venture debt, by definition of what it is lending money to companies that have taken venture funds. Well, having worked in that space, if you don't know anything about that space, it is a high failure space. You are looking for one or two companies to carry the return for the other 18 that went to zero. So, if you're going to do venture debt, diversification is a real key factor. You got to understand how you're diversifying across a variety of different sectors. That's probably one of the bigger due diligence aspects when I look at venture debt, is how diversified and how de minimis is each individual single position I have, because I don't want to be all in one place and my company went to zero, and but this other one went well, because majority of venture portfolios don't work out. Market and regulations. Yeah, you can have, as we showed in 2008, private debt does have its weaknesses. You got to understand that weakness. What is the left tail event that's going to, potentially, hurt, your particular private debt? Number 4, honestly, Hermes has been around me long enough. I should probably move number 4 to number 1. Operational risk. It is one of the risks that unfortunately you're not compensated for as an investor. But at the end of the day, if you're investing in a fund, you are investing in a company. And there are people who run that company, and there are processes and procedures that are involved in running that company, and we call that company a fund. There's no difference. I've run, small companies, and I've run funds. and they really operate pretty much the same. And so that operational risk is real, and it is literally 50 to 60% of the failures of funds. And it is also probably the most boring section of doing the due diligence. So, just like, everything that tastes good is not good for you. Well, everything that's boring is probably the most important thing that you probably should pay attention to when doing your due diligence. Everyone loves doing the investment side of due diligence, but that operational risk, that's where things can break. Valuation risk. This is it's you got to understand. Debt is the investment you're participating in, but what supports that debt and controls risk is the underlying collateral. And so you have to understand when things go wrong, what was the initial value, but how is it being valued when things are under stress? And for me, I'm not saying I don't like venture debt. I'm not saying that I don't like corporate debt, but I like real estate even for my own personal investments because even in the worst case scenario, I've got the optionality of saying, great, I have a building. I have a functioning building. Like we don't do raw land or construction. So you're not handing me the keys to a pile of dirt when something goes wrong. We don't do that. I want to basically have some kind of physical building and how I valued that and how that was run. That's a super important aspect of any private debt is how are valuations run is the accuracy of valuations. And I hate to tell you, valuation is an art, not a science. And so you're going to have some knowledge base or build a network around you. I talk about this in due diligence a little bit where, hey, you don't know something, find a network of people who do, and then go learn from that broader network and involve yourself in that network. And so that you can ask questions and come up the education curve. And you should be asking, like, okay, walk me through how you're valuing the underlying collateral that's supporting the debt. Because what often happens when something goes catastrophically wrong is, well, you're not left with anything when something goes wrong. And so that valuation wasn't done properly. And then you're looking at a situation where they didn't understand. Like the intellectual property is probably the biggest one, the biggest fallacy. If you have a fund that is investing in companies and saying, oh, but at the end of the day, I'm going to have the intellectual property of this company, I will tell you right now, it's not worth anything because intellectual property that doesn't generate revenue, you couldn't sell it on your best day. So that's not really an acceptable collateral to be holding on to in a total upside down situation. There's a number of companies in Seattle, obviously being a tech hub. We had so many funds built on the idea of I'm going to go in, I'm going to do this debt, and I'm going to be supported by all this amazing intellectual property. It's going to be awesome. That fund within 4 years closed because when they went to go capture this value they thought they had, there were no buyers.
Chris is one of the rare sponsors from Investors Row that does not like talking about his investment opportunity. He actually likes to educate. So I literally say, Chris, they're here to learn
Yeah.
about what fund is available. So do me a favor and just talk briefly about your fund.
Yes, very quickly. Um, Two key angles you want to think about when you're looking at something: inefficiency and edge. Inefficiency means, well, wait, it's a niche focus, it's a niche environment that allows us to create an excess return. The edge is the team that comes together. And real quick, it's myself and Brock Freeman. We started this back in January of 2020. Couldn't have done it without each other. He brought that underwriting, access to loans. I brought the risk, compliance, fund management, and everything else that goes into running a fund. And that's what's allowed us to be successful. And we've built a great team from there. But we are risk first. We don't do a set like I'm going to pay you 9% or 10% fixed. No, I run a basket of loans that is very risk focused. It is very the valuation we use as is valuations. We look to cut risk at every possible corner and then maximize the return that we can get from our particular niche space, which is micro balance commercial real estate bridge loans. So we had to come up with a new word because small in commercial real estate means like 25 million and up. Our loan size is 200,000 to 1.5 million. We find ourselves when we're writing loans that small, we are in secondary and tertiary markets. We're in underserved markets naturally. We didn't build this as an impact fund. We do have a number of impact investors in our fund. That it was not by design. We just saw the opportunity in these smaller markets. It turns out that we are actually lending to areas that are underserved, both from a monetary standpoint, gender standpoint, and ethnicity. Just kind of happens that way. We didn't build it that way. That's just the way it works. I like to be very upfront about that. We never market ourselves as an impact fund. That is up to your decision if you want to view us that way. That's not how we really view it. But it is that niche space that we happen to end in, that where you just don't see that constant flow of capital. So we get that loan demand on a repeatable basis from our loan broker market. It is about consistent and stable returns. It's been said by multiple. Warren Buffett, probably the best, is like, listen, or Charlie Munger, if you can compound at 8%, then you're going to win the war. They were talking about equity. They were talking about fixed income. They were talking about a portfolio as a whole, or the equity piece of that. And now in today's world, you can have a piece of your fixed income that can produce 8, 9, 10, maybe higher. I mean, as a mixed basket. So be sure to diversify, be aware of risks, but fixed income is now a real potential tool that can generate real income that's usable, or even be a serious tool for capital growth of your fund, of your investments in your portfolio.
Chris, you're the best, man. Always appreciate you. Very educational. To you IRA Club members, I hope you guys learned something new today.
As always, we're going to have to do 2 webinars. I can't talk about my fund and educate. It just takes too much time.
No worries, buddy. Till then, got it. Take care, guys.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.